I want to welcome Andreas Steno Larsen, who is the Chief Global FX and Rate Strategist at Nordea. Welcome.
Thank you so much.
No problem. Super excited to have you on because you really dive into the data and really dissect these markets and understand them. So first kind of question, actually, I've heard you mention that the US dollar is the most important metric to look at in terms of like understanding the markets because it moves so much, other assets. So what is your take on kind of what's happening to the US dollar currently?
Well, currently it's kind of boring. We've seen a summer of a slightly stronger dollar, and I think it could be an early warning signal that something is coming up. The focal point here is whether the Federal Reserve will allow the dollar to strengthen or not, and the big question is whether they will allow the tapering process to roll out early or not. And my take is basically that the Fed is preparing for a very aggressive tapering scenario in a lot of ways, mostly technical ways so far. They haven't admitted to it rhetorically, but in a lot of technical ways, they're preparing for the scenario. So it's a really, really important point to watch the dollar price action over the coming months, since it is the early warning signal that you need for most assets, I think.
It's funny, like, why do they think that the market can sustain any sort of hawkish tapering? Because it hasn't been able to do that really in the last 10 years.
Well, I don't know whether it's within the Fed mandate to look at stuff like that. At least they're still stuck in a very academical discussion on inflation, on the employment target, and for them, they don't see the direct link between equity prices and inflation and unemployment. So usually the line of events is that they try when inflation and labor markets tell them to, and then the market kind of forces the Fed's hand back into QE, right? And I think something similar to that will happen this time around.
Okay, so that's huge, and actually a lot of people have been alluding to that. So that would mean that they would try to do their whole tapering song and dance essentially, and then the markets would react really kind of forcefully against that, and then they would be forced back into the whole QE regime again, right?
Yeah, definitely.
So then, does that mean we're in the same kind of scenario where they just keep propping up assets and crypto and tech stocks and just everything just goes through the roof continuously?
Well, I mean, if you look at it right now, the debt burden that's been built up over the past few decades, which has accelerated quite rapidly through the COVID crisis here, I think the only politically feasible way to get out of that scenario is via ensuring that real rates remain very negative for a very long time. So from the Fed's perspective, they will basically like inflation to print at 3% on average, while they keep the nominal interest rates below that target for decades, because that's the only politically feasible way to get out of this. And that obviously means that you will get positive spillovers to lots of other assets. So I think that's a scenario that you're staring into for the next decades also, yeah.
They would probably never admit that, right? But you're right. It's the only way, right?
Well, I mean, to them, that's just a side effect. It's not the main effect of the world that they live in. So obviously, they won't address it directly, but it is a side effect that they will have to live with.
Right. So the bondholders, the interest rates the bondholders get is going to be lower than inflation, and therefore, anyone who's why would people continue to hold the bonds then? Yeah.
Well, first of all, a lot of people are basically required to hold bonds. If you take the bondholders and sort of deduct them into subgroups now, of course, the central bank owns a lot of it. Secondly, banks hold a lot of bonds simply due to regulatory reasons, and that will remain the case. And then thirdly, a lot of asset managers, they simply have a mandate in which bonds make up a large portion of it. So there are a lot of buyers of bonds, and in particular, when you still look into a scenario in which the central bank's buy a larger and larger portion of the market, then I guess it's not an issue to keep interest rates low.
Yeah, it seemed that way. They've been able to do that for a long time. Well, actually, a kind of a threat to that would be inflationary scares, supply chain disruptions that a lot of people are pointing to, like commodities spiking. What if a supply shock in oil happens, and just there's like this fear, kind of like the 1970s, right? Where yeah, real rates were negative, but rates rose like crazy, right? And just in addition, like kind of all part of this big inflationary scare. Gold, silver, everything skyrocketed. Could that be kind of this wrench that's thrown into the Federal Reserve's plans? Or?
Well, let me be as straightforward as I can be. I would always have a portion of my portfolio in gold, for example, into this scenario. And I think it is a low probability scenario still that we get into a 70s kind of environment, inflationary wise, given that we're still very, very far from such a scenario. But I think we've had a regime shift in a couple of ways over the past 2 years. Firstly, on the fiscal front, when you introduce a new set of measures such as direct transfers, it's just very, very difficult politically not to consider those instruments perma instruments now. Every time something turns sour in the economy now, you should expect direct transfers to be introduced again. So it is a perma instrument, at least from a crisis perspective now. And therefore, you should also expect fiscal deficits to run much, much harder than what you've seen over the past decades, over the coming few decades, next few decades. So that's a clear regime shift. Whether that's enough to really prompt a massive inflationary regime shift, I kind of doubt that, since we still have these long-term secular trends that point in the other direction. But compared to what we've seen over the past 10 years, then yes, I would bet on high inflation over the next 10 years.
Okay. But it'd probably be a short-term move, but long-term, you still have your secular deflationary.
Exactly. And I mean, we could get some very, very ugly numbers this year from the US, also much worse than what we've already seen. But it isn't that big of a deal, given that a lot of it will, per definition, be proven transitory, right? I mean, inflation is transitory per definition. It's just a matter of how long a time frame you measure it from.
Gotcha. Okay, so that's the great debate. But you still think hold some gold, right? Just in case, just in case. But so then that's kind of the question. Like, how long can the Federal Reserve, and actually governments all around the world, and it's the $1 million question, no one really knows, but how long will the confidence in their ability to just print money and stimulate and keep rates low, like how long can they do that for before confidence runs out? At some point it would have to, right?
But I mean, there's a huge difference between the way that central banks print money today compared to the very, very ugly episodes of money printing that we saw back in the 30s, for example. The difference being that when you print a dollar today, it's essentially just a dollar that fluctuates within the banking system. It's not a dollar that will reach the real economy. Per definition, when you print a dollar today, you just buy an asset from a financial counterpart, and that new digital dollar will only be able to transfer around within the banking system. So I don't think that you can compare the current money printing to the very ugly episodes of current money printing that we've seen historically. And therefore, I think there is a much longer time frame for this kind of money printing compared to the episodes that we've seen historically.
That's true, yeah, and it's been proven that way, right? So they've kept it in the banking system. Financial assets have gone up insane.
Yeah.
So then why own gold in this environment if they can just kind of like keep it trapped in financial markets is my question.
Well, I mean, if you look at the gold price right now, I would argue that it should have traded above $2,000. If you look at the connection to real yields, for example. So I'm a bit puzzled why gold isn't performing right now to the extent that I expected. The question is whether the market is too scared of tapering to really buy the gold story currently. I don't think tapering is is a super tactically good thing for gold. So that could be one reason why gold is held back a little bit by all the tapering debates. But otherwise, into such a scenario with decade-long negative real yields, then of course gold should perform.
So, okay, gotcha. So I think we covered that, like long-term deflation, the Federal Reserve, can keep this kind of, I guess, money printing regime going, right?
Yeah.
In the bank system. I mean, there will be fiscal stimulus, like the infrastructure bill, $3 trillion. You don't think that'll move the needle too much in terms of actual like inflation in the economy? If they actually put that money into the economy, not in the banking system.
Well, I mean, inflation, at least in the way that we measure it, when it's always a measure against the prices the year prior, for that to continue, you obviously need to stimulate the economy every year. So what you see right now is effects from the stimulus in 2020, and that's why we have a massive effect in prices this year compared to last year. But from a momentum perspective, stimulus is fading. Even if you do the $3 trillion stimulus package on infrastructure, it will still be less than what we saw last year, meaning that inflation will basically turn south from a momentum perspective. So I mean, you continuously need to put the pedal to the metal before inflation rises, right? So I think it's impossible to keep stimulating at a larger and larger pace.
Gotcha. Okay, so it's on a rate of change basis. If you're comparing year over year over year, it has to be more and more and more for it truly to kind of be exponential.
Yeah.
Okay, that's interesting. Gotcha. And one thing I've been really struggling with here is so Japan, right? So hasn't Japan already tried this, right? They've thrown just helicopter money at the problem. They had a massive bubble in the I think 90s / late 80s, massive bubble, but now they have just and now it's coming back up, but they had 2 decades of just pure crashing stock market essentially.
Yeah.
So is that a possible scenario for developed markets like the US and Europe? Because we're seeing this huge bubble in financial assets, but could there be that like lost decade?
I sincerely don't hope so, but I fear it. Since, I mean, the vast thrust of sort of support to risk assets from lower and lower and lower interest rates, we've already seen that, right? I mean, I struggle to imagine a scenario with much lower real yields than what we have already, because it's more or less impossible to get to such a scenario, at least without inflation going bananas, right? And it's still very clear when you talk to central bank officials, both in Europe but also in the US, that they don't really like a scenario in which they have to cut nominal interest rates a lot more than what they've already done. So I struggle to really see how we get a massive support to risk assets from monetary policy over the next couple of decades, because interest rates matter more than money printing like QE in my world for risk assets.
Right. So you're saying their ability to I mean, because once rates are low / negative, there's just not much else they can do.
No.
So you're saying eventually they're going to run out of options, and financial assets are probably going to just do what they want, and there could potentially be this lost decade theoretically if they can't do anything about it, right?
Yeah, sure. That's clearly a possibility, or maybe just a decade of sideways trading, right?
Right.
So what's the next sort of wave of support? That's really tricky to find when you are already at rock bottom and on interest rates, right?
Yeah, very interesting, very helpful. Thank you. So then I just want to move over to this really interesting area of the market, Chinese equities. We're early stage investor, all about trying to find some early stage value, right? Stuff that's really beaten down, cheap, that could potentially 10x in the future if you hold it. Chinese equities just completely smashed. So my question is, and I've avoided China just because it's like, I don't want to invest in a communist regime. It's like they can just throw anything at you. And it just doesn't really work out that well if people aren't free. So what do you think about the Chinese equity situation?
Well, I have to admit that I am actually a China bull, both tactically and structurally. I think, first of all, the launch of the digital renminbi next year will be a game changer for Chinese macro, as it will slowly but surely open up capital markets, first of all, regionally in Asia, but secondly, also to the rest of the world. I think that's the plan. But if you look at it more tactically, Chinese equities have taken a beating recently, mostly on the heels of a very, very negative credit impulse in China. So the Chinese authorities, they've basically slowed the economy on purpose. It was running too hot post the COVID reopening. And right now you see the first signs of the Chinese authorities reversing this course. So they're trying to sort of refuel the economy now. So that could be an early sign to enter again. And basically, if you look at equities worldwide, it's tricky to find a cheaper market right now, I think.
Exactly. Yeah. So that really caught my eye. And I remember like a month or two ago, I think you were talking about how China was kind of slowing down their stimulus. And so this is kind of isn't, if you think about it, a huge surprise, right? If they're slowing down, then obviously risk assets are gonna correct. So I guess you could almost say you foresaw that. So here we are, and now you're saying they're reversing. They're reversing.
Yeah. So I mean, what I would watch now is the Chinese credit impulse. So the amount of credit created in the economy as a percent of the GDP. When you see a reversal in that, it's the first sign to enter China again. That's usually a time series that tend to lead the developments in risk assets by between 9 and 12 months. So that's the one to watch.
That's really interesting. And yeah, so it looks super inviting to see, a whole stock market just totally crash like this. The question is the risk though, and the reason why it's like that is because they're very authoritarian. They could just regulate like growth businesses like video games or tech or whatever. So are you worried at all about that?
Well, not to that big an extent. The interesting thing is that I don't know where exactly you're from, Elliot, but when I talk to Anglo-Saxons, they've rarely visited China. I've been there quite a few times, also doing business, and to me, it's one of the most business-friendly countries in the world. It may be a very top-down approach that they run the country via the Communist Party, but they always have an eye for business, and I think that will remain the case. They're not stupid; they're just authoritarian. So I mean, from a business perspective, I'm not too scared of owning Chinese stocks. It's as simple as that.
Wow. No, that's huge. I love hearing that because I'm always looking for an opportunity and that market is very depressed. So long term, their focus is the economy and the business, and they want their stock market to go up. So they're going to do whatever it takes, and they have the power to, clearly, because they're authoritarians, right?
Mm.
Cool.
Yeah.
Okay, and the governmental stimulus is starting to change, so it could be an incredible opportunity. You're saying
I mean it's definitely on my watch list over the next quarter here to turn very positive on China again.
And then another question I have for you, right? So as long-term investors, just looking globally, because it's hard to get excited about buying U.S. stocks when they're just so high, right? Just straight line up. Looking at other opportunities worldwide. So Europe stocks are up too, right?
Yeah.
So I guess they're kind of in line with US stocks, but do you ever see kind of a divergence where European stocks kind of take the lead again?
I think it's not a high probability event. Let me put it like that. I mean, if you look below the surface in equity pricing in Europe, the few very profitable companies that we actually have left in Europe, they are very, very expensive already from a multiple perspective. Just look at the pharma sector in the Nordics part of Europe. Just look at the luxury companies of Switzerland and France. They're very expensive from a PE perspective already. So I actually think that the good companies left in Europe, they're very expensive already, as is the case in the US. So I don't think that there is such a huge divergence between the US and the European equity pricing. It's just a matter of more US companies being very profitable compared to the European ones.
Okay, fine. So I get it. Developed markets, just the money printing bubbles have just propped this stuff up. as high as it can almost go. How about EM? Because I don't know if you've heard this exponential thesis trade where, EM markets, they're just all going to get this like internet, just immediately Wi-Fi through, I guess, Elon Musk's like Starlink. Regardless, tech developments are just going to be spread throughout the emerging markets, and that should really be a boost to their economies. Are you seeing any value in EM at all?
Not from a tactical perspective, but from a structural perspective, yes. Right now, I'm too scared of the Fed preparing for this tapering scenario in September to enter EM, broadly speaking. China is one to watch, but otherwise, it doesn't look like a good case in the short run. The issue here is obviously when the Federal Reserve starts withdrawing liquidity, which they will attempt to do during the early parts of the autumn, in my view, then you also slowly but surely attract money inwards on the risk curve. So the first countries that are the most risky EM countries, then you tend to see underperformance in small caps in developed markets. That's basically also what we've seen lately. And then next up is sort of a more broadly speaking sour risk environment for equities. If I'm right on my tapering view, right, that would be the next step. So the chance to rejoin the EM party will obviously arise at some point, but not until the Fed reverses its course on QE.
Okay, and that's similar with a lot of asset classes, right? I mean,
yeah.
So they're going to start.
Yeah, but it's just the high beta asset if the Fed continues, right? It will be the most high beta asset.
Okay, that's so interesting how EM is directly correlated to the U.S. Federal Reserve, right? But I would think that any dollar weakness and you see EM strength, right?
Yeah, sure. And right now I'm basically in the opposite camp.
Okay, brilliant. Well, that was just so awesome. I really appreciate that. We just traveled around the world and just like got a lot of great insight from you. So thank you so much. Where can people go to learn more?
Well, first of all, you should of course follow our research. So I'm on Twitter, Andreas Steno Larsen. Otherwise, follow Nordea Markets on Twitter. Else, I tend to learn the most from reading macro strategic blogs. I rarely get a lot of info out of mainstream media. I think it's almost mainstream to say that you don't read mainstream media right now, but I think it's the case that you never really learn anything from reading mainstream media in terms of getting an edge on markets. So read the small blogs, read people with niche theories on what's going on, because that's where you get an edge. So that would be my 5 cents on where to collect info.
Perfect. So before it trickles into the wider consciousness, you want to be early and get the more niche kind of sources, right?
Exactly. Yeah.
All right, perfect. Well, thank you so much for stopping by. I really, really appreciate it.
It was a pleasure. Thank you.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.